we can now bring in Charles. Charles, are you there?
Yes, I am.
Brilliant. So, probably many of you know Charles, but I'll just quickly run through who Charles is. So, Charles, Director of ICM and Chief Executive of ICM Investment Management Limited, where he runs UIL Limited and Utilico Emerging Markets Trust, we're going to talk about today. Charles has over 30 years of experience in international financial markets, most of which he's got from sort of time at ICM. As I say, he's qualified chartered accountant and extensive experience in corporate finance and asset management. Charles, would you like to give us a sort of extended elevator pitch of why we should like UEM, please?
Matthew, would be delighted. And I think I shared some slides with you, and if we can just use that for context and maybe go to page 1 of the presentation.
Okay.
So trying to, if you want, give you an overview. Top right, predominantly emerging markets. So we're focused in on, countries like Brazil, India, Vietnam, the Philippines, and over 95% of the portfolio is invested in those markets. Top left, operational infrastructure and utility assets. I think we're unique in our approach across the emerging markets to focus in on that asset class. There are more than enough investment opportunities, and by being a specialist, I think we can find the ones that will deliver the long-term returns we're looking for. Just to emphasize operational infrastructure, 95% of our assets are listed on stock exchanges, and again, over 95% are operational. So they are owners of a runway, an airport, a port, a toll road, as you were talking about earlier, transmission lines, and we're looking at those assets and how they can perform and what the drivers are. And I think that the nature of the asset gives us a lot more confidence about the outlook when we're making investments. Bottom left, just to note, we are bottom up. So we don't start out with a view on a weighting in the portfolio. We're very much bottom up. We're relentless. We keep behind management teams in terms of understanding their approach to the business, just making sure that they deliver to the expectations that we are setting. Benchmark agnostic, as I've noted. I always comment when I come in that I don't think anybody in our office would be able to write down the components of the MSCI index. It's an outcome, and in terms of bottom up, our portfolio is an outcome. Long-term investment horizon. I think the nature of our assets are that they're here for 30, 40, 50 years, and therefore we can look through to, if you want, the medium to longer term economic drivers. And especially at the moment where there's a huge amount of noise in the wider markets, that opportunity to look through and say, the asset will return and perform in time, what's it going to deliver to us, I think is the real strength of the proposition. We do build in ESG. We have our own template because most of our investments are outside indexes. We've developed our own template, and it does go into, if you want, the decision tree. We're not driving for outcomes, but we're definitely trying to engage with investee companies on their journey. The upshot of all of this is a strong return. Bottom right, however you want to measure it, whether it's a year where we are up 10% through end of January versus the index, which is down nearly 6%. And, we've been a good short-term, medium-term, and long-term performer. So happy with the outcome. To try and unpack it a bit more, the next page. So unique features. We are exposed to the megatrends, and I'll come on to those. There are 4 megatrends that we feel are driving, quite frankly, global economies, but they absolutely apply to the emerging markets, and I'll come on to that. We are focused on utility and infrastructure assets. So, as I say, things like ports, airports, stock exchanges, things that have a monopoly characteristic, and we can have a look at their business models and rely on their defensive moat to deliver the values looking forward. Real assets, as I've stressed, they're operational. I think something to note, we continue to see top line growth at the moment in terms of volumes. We continue to see pricing firm, and while costs are rising because of inflationary pressures, I think at an EBITDA level, they continue to outperform quarter on quarter, year on year. Most of them have long-term stable cash flows. They're predictable. We can model them out. We can hold management teams to account. And I think that's a real benefit, because we're not seeing huge dislocations within the underlying investments. Experienced management team. I've been with the fund since it listed in 2005. I think we've got a long-term track record. It speaks for itself. And we do absolutely look for the best opportunities. Strong performance, as I've commented already, I think the numbers do speak for themselves. One thing to note, though, is we do have a low beta. It's not something we manage for, but it's an outcome. We have a low beta under, I think, 0.8. And so the performance that we're delivering is in the shares that we are putting into the portfolio. So it's a real validation of our process. And to note, over 98% of our portfolio is an active share, i.e., I think investors would struggle to make a comparable set of investments to us if they were looking to funds that are nearer to the MSCI index.
Yeah.
Next page. So megatrends. And just to note before I get into megatrends, we are still seeing the underlying characteristics, in my view, of emerging markets. So I was in Vietnam in November, and you can see the rate of urbanization is still very evident. And I think their urbanization rate is running at about 40%, and it will continue for some time. And that's the case in most emerging markets. So we're still seeing cities grow. We're still seeing a middle class within cities grow. And they're the users of, if you want, our portfolio. They're the users of the airport, of the data centers. But notwithstanding that, I think globally there is a lot of change underway. And this is mirrored in the emerging markets, and at times stronger, because they're starting without legacy assets. So energy transition, they are clearly focused on achieving net zero targets, and investing significantly into hydro, into wind, into solar, and very often, as in the developed markets, the wind resource, if you want, is not where the urban population is, and therefore you need very significant investment in transmission lines. And so we're seeing a lot of really attractive investable opportunities, and that energy transition will continue, we think, for the next 10 years. There's clearly also in the background a degree of energy resilience, where countries are looking at exactly where they're sourcing energy from and how can they make their own economies more resilient to the energy challenges. Digital infrastructure, I think everybody's on the same page here. The emerging markets are behind in terms of penetration, but the characteristic is exactly the same. The growth rate is bottom left top right, and that continues to be a very strong trend. And I think if I look at AI and the demand for data, the use for data, it will continue for some time. And certainly within our portfolio and within our discussions, we're seeing that very strong trend. And that, again, that should continue for 10 years. Global trade, I know a lot of people come at us and would say the global trade is challenging, it's flat, it's not at the growth rates that it was 2, 3, 4, 5 years ago. That's true. But I think what is happening is an absolutely monumental shift in, if you want, trade relationships. So we're seeing friction between the US and China. And that's spilling over into what's termed China plus one. So corporates are looking at where their production facilities are located, and they're not leaving China, that's for certain. But the next decision to invest would be in, say, Vietnam. So you see Apple looking to invest in Vietnam. You see Tesla looking to invest in Mexico. And that shift is providing a real opportunity if we can identify the ports, the logistics infrastructure that will benefit from it. And again, we think that this will continue for some time. And finally, social infrastructure. Many of these countries are on a journey to achieving better outcomes for their urban populations. And legislation keeps being introduced to support the deepening and development of social infrastructure. So things like waste treatment in Brazil is a big beneficiary of legislation that was brought in 4 or 5 years ago, requiring a tidying up and an improvement of waste treatment. And these 4 megatrends, we think, give us real confidence when you marry them up against, if you want, the normal dynamics in an emerging market because of the nature of the assets that we're invested in. The next page. And I'll try and just skip through the next 4, but just to give you some feel, you can see a picture. Here's a wind farm in Brazil. It's our number 3 investment. Their major asset is the transmission lines, but they are adding to their portfolio. You can see wind farms. And while there are challenges, I think better management teams are able to bid for assets and then bring them online quicker, bring them online at a lower cost, and operate them at better outcomes. And the returns that are available are significant. So we see this as a very attractive space for the next 10 years. Next page. Data centers, as you'd all understand and agree, there's bottom left, top right driver here, and the emerging markets are absolutely no different. We're seeing a number of investments in our portfolio in the data center space, quite frankly, filling up as quickly as they can add capacity. I think the big trick with a data center is to make sure it's a bit like property. It's location, location, location. You want low latency. You want connectivity to be high. And the assets that certainly we've got are benefiting from a demand for capacity. And I don't see that abating for some time. And that's a real attraction for the portfolio. And some of the management teams in this space, if you take a company like an FPT, which is, I think they are now $5 billion market cap, US dollar, based in Vietnam, their growth dynamic is very significant. And they've delivered a strong performance year on year for the last 5 years, growing top line by 20%, growing their bottom line by 20%. And if you talk to management, their expectations almost for an acceleration given the footprint they now have. So exciting business to be an investor in. Global trade, next slide. I think I've highlighted it. There are, as I say, two factors here. One, China-US friction and the shifting away from China. The other is, I think, a real focus on supply chain, which came out of COVID as a big driver, where corporates found themselves dependent on a very narrow and a very efficient supply chain. But when it got disrupted, they found that their business models were properly challenged. And so they are looking to diversify away from a sort of single supply chain, and they're looking for multiple supply chains. And they're also looking, I think, for supply chains which are a bit shorter. And so you're seeing a lot of what's called nearshoring. And all I can say is, having been to Mexico in March last year, and I'm going in 2 weeks' time, and I'm sure I'll see it again, the warehouses are full because industry is relocating manufacturing into Mexico. And you can see from the graph bottom left that the emerging market share of global trade is continuing to grow, and that's a real strength for us. So a lot of dynamic in this space, and therefore a lot of opportunity. If I go over to social infrastructure on the next page, as I've said, this is driven by need for clean water, the need for treatment of waste, the need for better outcomes for middle classes. And a company like Horizon, which is acquiring a number of waste sites across Brazil and then taking them on the journey of not only being a waste site and they get paid a fee for taking the waste, they're sorting the waste and earning a fee from recycling. They are capturing, if you want, the methane and energy, and looking to sell it back into the grid. So all of that drives a real outcome. I think, and I do recognize time's running on, I think just over the page, a couple of highlights to note. Inflation is not been a factor for the portfolio. A lot of our assets are inflation adjusted, and therefore it hasn't been a factor. Interest rates, the portfolio tends to be lowly geared when you look at the sort of developed world sector. And why is that? I think their opportunity is raw growth. Their opportunity isn't to leverage a balance sheet. So it's not been a real challenge over the last 12 months. Geopolitical tensions, I think as an investment team, this probably takes our most attention. But I think our strength is being able to look through, if you want, the noise that comes out of, say, Lula in Brazil, and understand what's happening in the real economy. Couple of final things on the next slide. And you'll have heard this before. Emerging markets are undervalued. If you look at the 10-year average on the left, we're significantly undervalued. If you looked at our portfolio, we're absolutely no different. And I think our portfolio is yielding, giving you a sector-leading performance. We've got a high dividend yield, and we've got low volatility. And our discount on our shares is clearly giving you an entry point. I think on two other points just to highlight, because I do recognize the time. If we jump 2 pages, clearly the performance has been extremely strong and consistent, and we're very proud of that. We obviously want to see the discount narrowed. We do buy back shares. We are consistent in the market. I always look at the portfolio and say, I'm happy to buy the entire portfolio. So why wouldn't we buy back?
Absolutely.
Dividends are a strong feature. Next page. We pay our quarterly dividends. It's an outcome because of the nature of our assets, which are cash flow generative, over 80% pay a dividend, and we obviously pass that on to our shareholders. And that's an outcome that will remain and consistently underpins. So I think that's giving you, I hope, a real helicopter view.
Excellent. Thanks for that. We've got sort of quite a few questions come in, so let's flip over to those. Now, the question here is, what processes does UEM go through to calculate appropriate risk premiums for utility and infrastructure investments? I think probably the broad question is, how do you balance risk and return when you're assessing investments? I'm guessing probably a good understanding of the regulatory environment, local politics is key.
Absolutely key. So I think experience of how the local markets respond over time. So regulatory framework and performance is important. I think very important is to make sure that we have a diverse portfolio. None of our investments are above 5%, and that's a conscious decision to try and take out, if you want, the downside risk of an investment getting into trouble. And it's a competition to get into the portfolio is the best way I can describe how do we look at investments.
Right. Okay, no, that makes sense. Just sort of, I guess, related to that, what's your approach to, or what's the gearing policy with this? I mean, I imagine it could support gearing just because these are cash generative assets that are mission critical for society. But I mean, do you guys employ gearing? How do you go about managing it if you do?
So we've got a £50 million facility. We're a 550 million gross assets, a 10% facility. Today is 25 million drawn. Probably says to you we are positive, so optimistic, but we're a bit cautious because there is a lot of dynamic in the wider markets.
That makes a lot of sense. What does the interest rate look like on the facility?
It's about 130 basis points over the currency we borrow in.
Yeah. Okay, that makes sense. All right. Next question. Now, I guess the answer is you've got quite a decent exposure to this, but the question is, how have managers gone about anticipating the effects of climate change on the investment portfolio? Well, clearly this could affect everything, but you're specifically targeting the energy transition, aren't you?
We are, and it does factor. I think, we do look at things like El Nino and all these climate impacts on the asset that we're investing in. And, the opportunity to invest does range across river, transportation, etc. I think we'll put a higher premium where we think that climate could have an immediate impact, but it certainly comes into our discussions. It certainly comes into our thought process.
Okay, that makes sense. Somebody's asked you, can you explain the structure of your credit facility? But it's a multi-currency credit facility, is that right?
It's a multi-currency revolver, yeah.
And we understand this, so I think we've answered that already. So let's dismiss that. Said, what strategies are in place for achieving dividend growth greater than inflation? I mean, I think you were saying that really the dividend is a consequence of the investments, isn't it, rather than something you're specifically targeting? But can you expand on that at all?
It's an outcome, and I expect it to continue because of the nature of the portfolio, whereby they're cash generative. And one of the things we do is make sure that the shareholders are aligned with us, that they do want to see growth on the one hand, but on the other hand, they do want to see a dividend.
I mean, perhaps related to that, because obviously, the inflation that we're experiencing here is going to be different to what is being experienced in all your markets. I mean, typically, actually, it's sort of lower inflation there, albeit, we're possibly benefiting more with the sort of state of the sterling, as it were. But sort of how much inflation linkage do you think there is in the sort of portfolio?
It varies. I think Latin America, inflation is actually a big issue and something that we do take into account, but it's always had inflation and manages its way through. I think Asia has been much more about property across most of those markets, and inflation hasn't been a real issue. If you're honest, China is actually facing deflation.
Yes, absolutely. Got a question here. Somebody's obviously noted that you've got a decent slug of the portfolio in India, and sort of asking about your general outlook. I've just got my own question related to that. Is that something, because obviously the Indian market has done very well, but how have your holdings performed, I guess, in that sort of context? And is that something that you've had to trim back at all, or has that not been much of an issue?
So it's asset by asset almost, but we've seen strong benefit from investments in India. Modi is doing an extraordinary job of opening up the economy and enabling the economy to perform. So electrifying and putting in transport infrastructure has been an enormous driver. We have 2 or 3 investments. One is in Power Grid India, which is the biggest transmission company, I suspect, in the world. And they have a really good, strong management team and strong performance.
Yeah. I guess sort of related to that, there was a question: do you sort of have an outlook on the Indian election and what will sort of happen there? But there's actually a sort of related question, which is, are there particular regions or sectors where you see opportunities or risks stemming from the various upcoming elections? So I suppose we could include India in that. Do you have any sort of views?
So most of them, India, I'm putting on one side the politics. We expect Modi will be re-elected, and he's been good for the economy. So why wouldn't it continue? I think Indonesia, where we have seen a change, we still expect the approach to be a good outcome for, if you want, investors. So we'll look at the underlying dynamic. If you want strength of the institutions and the underlying dynamic in what's the policy the government is seeking to follow.
Okay, that makes a lot of sense. I think apologies to those that we're not going to be able to get all of the questions. I think we've got time for one more. And really, it's just asking what the sort of rationale is behind having, they say, sort of close to a quarter of the portfolio in Brazil.
So we've understand Brazil, I think, over the decades. We've had 30% before, down to 8, back up today to 24. It's an outcome. A few things, or 2 things I'd note about Brazil. One, there is a significant amount of oil coming online from offshore pre-salt that is now coming into the economy. And this is a country that does not need energy. Most of their energy comes from hydro, wind, solar, and therefore it ought to be a proper elevator or underpin for the currency and the wider economy. I think also they've invested very deeply into logistics and supply chain, all of which ought to give them resilience in a global economy facing change.
Brilliant. Okay. Well, we'll have to leave it there. But thanks, Charles. That's been really helpful, useful insight into what's going on with UEM and sort of the outlook, etc. Hopefully we'll be able to get you back on, I don't know, about a year's time, and you can give us an update again on how it's all going. Saying once again, thanks to Andrew. That was another excellent sort of update on the month that was. If I just skip forward, there's the sort of usual legal bit we have to give you. If you haven't got a chance to read that now, perhaps pop back and have a look at that sort of later. As usual, we've got plenty more events lined up. So as you can see, we're booked through March and I think into April. Come back next week. I think James should be here talking to Richard Aston of CC Japan Income and Growth. And then on the 15th of March, we've got Stephen Treasure of Oakley Capital Investments. And then on the 22nd of March, we've got our first quarterly panel discussion. which obviously has, these are entitled, has the tide long, or tide turned. As I say, we've got things going into April as well. But say, thanks very much for joining us this week, and we will be back next.